Every year, we conduct a client survey which provides insights into investor needs and trends. Last year, more than 4,000 of our clients participated, and we remain thankful that you are prepared to provide us with your feedback. One of the questions that provides very valuable input into our planning relates to investors' return expectations mapped to the different investment needs across the risk-return spectrum. Investment is a forward-looking activity, but because the future is unknowable, we all tend to anchor our expectations on the outcomes achieved in the past. Our job as investment professionals is to think dispassionately about where the current facts indicate that the future will rhyme with recent experience, or whether there is a likelihood that outcomes may be very different. When a gap emerges between what clients expect and what the market fundamentals indicate will happen over the next several years, disappointment or regret are the likely results. There were two key observations from the results of the most recent survey. The first is that investors expected a similar return across all mandates, irrespective of risk. Finance theory posits that higher levels of risk should, most of the time, translate into higher returns. After all, why would investors continue to take more risk if they were not rewarded for it? Over long periods of time, this relationship holds true. However, between 2015 and 2020, investors with exposure to the local equity market were not compensated for taking on additional risk. Disappointing returns from SA equities led to investors losing faith in the equity risk premium, resulting in reduced expectations for the asset class. The domestic economic environment remains undeniably challenging, but there are two big reasons why we think investors in widely diversified growth funds, such as Coronation Balance Plus, can expect better outcomes over the next decade than the last. The increase in the international allowance applicable to retirement funds from 30% to 45% in early 2022 widened the opportunity set. We have made full use of the rule change and are excited about the prospects for the equities and bonds selected from around the globe that we have added to the fund. Domestic assets are much cheaper than in 2015, reflecting investors' low expectations. We believe that even in a tough environment, a carefully constructed portfolio of winning businesses across industries will continue to deliver reasonable outcomes. In tough times, the strong tend to get stronger, while the weak tend to weaken. The second observation from the survey results is that investors expect 12% from income mandates. This is approximately 7% above inflation. Over the past decade of low growth in the South African economy, there has been a material increase in demand for managed income funds such as Coronation Strategic Income. The All Bond Index returned around 8% per annum compared to the 6.4% per annum from domestic equities. The classic income fund objective of beating cash over the medium term while protecting capital over the shorter term proved very attractive to conservative investors in a challenging environment. We are, however, concerned that investor expectations have become heroic. We think investors are anchoring their expectations on data points like these. The 10-year government bond currently yields 10.1%, and the prime lending rate is 11.75%. We've seen 9 consecutive increases in the Reserve Bank's policy rate since November 2021, when inflation became an issue in the post-lockdown era. 5-year fixed deposits are available at interest rates of up to 10.75%, which is very similar to the return produced by Strategic Income last year. The reasons why we think that expectations from income funds are too high are as follows. Most managed income funds are conservatively managed, which makes them more comparable to 2 to 3 year fixed deposits, where yields currently on offer are lower than those available from longer-term fixed deposits. More assertive fixed income funds, such as the newly introduced Coronation Active Income Plus and the Coronation Bond Fund, more closely resemble the yield profile of longer-term fixed deposits. Managed income funds aim for a return of cash plus 2% over the medium term, while aiming to keep the return as close as possible to cash in more challenging periods, for example, when interest rates rise. Assuming an average inflation rate of 4.5%, and 1% real for cash, this target translates into a return expectation of around 7.5% per year over the medium term. We are near the end of the current rate hiking cycle. This means that the current policy rate of 8.75% will likely drift lower later this year, taking all more conservative yields lower. All interest rates in the market, regardless of risk profile or product structure, will eventually be impacted by changes in the official rate. There is another important caveat. When you see supposedly conservative income funds offering yields that are much higher than the framework I just set out, you need to understand that there is additional risk being taken, whether you are being told about it or not. We believe in the maxim that happiness equals reality minus expectations. So with this in mind, we think we would be doing you a disservice if we do not try to close likely expectation gaps when we spot them. Recalibrating your long-term financial plan on a regular basis is a critical step to achieving your long-term goals.